Let's talk capital gains.
Capital gains tax. It is a lower tax than your average earned income tax. So one of the basic strategies is to do the math and consider actually paying the tax. Because sometimes that's the most efficient thing to do.
And typically that's 15 to 20%, right? And not including
it works
state.
To 20 to 23%, depending because of the Obamacare tax. Yeah.
Okay.
Now, state by state, some states recognize capital gains. Most states do not. Most states, and particularly in the state of California, consider it earned income. So we have to be very cognizant of your state implications, not just your Fed, right? So knowing that, what can we do about capital gains tax? As my daddy said, if somebody's willing to write you a big, fat, stupid check, maybe you should ought to cash it, okay? That's first and foremost. Capital gains tax should never stop you from selling a property. What it should do is cause you to get in touch with somebody like ourselves so we can walk through how to mitigate, offset, defer, or even eliminate the tax. There's several different techniques, and I'm just going to give you a couple of quick highlights. Number one, you can offset the tax. This is very common, particularly if you've already cashed the check and the sale is already done. Now we're looking for offsets. For instance, the cost segregation. Now, here's an interesting one. Imagine I borrow money, OPM, go buy a property, get that property, do an accelerated depreciation, a cost seg study on that property. Don't I get a tax deduction with tax-free money?
I love it.
It's mind-boggling. And cost segregation is ordinary. This gets a little weird. It's ordinary income. It's more powerful than the capital gains tax because capital gains tax is at a lower rate than your ordinary income. So we can leverage it. You don't have to have a dollar for dollar offset in order to get to a zero tax, is the bottom line.
So just add to that is what Jim's talking about is there's a property that's sold by doing a cost seg on another property that they own, not the property that was sold.
Yeah.
Right.
Important differentiation there.
Yep.
Can you, and obviously with cost segregation, I mean, if you sell that property, that depreciation you took is recapturable to a certain degree,
Correct.
but you can 1031 that again, right?
Yes.
Okay.
You can 1031 exchange out. You can reverse 1031 exchange. In other words, you can buy the property first, sell your property, and then exchange.
Mm-hmm.
You can do a straight 1031 exchange, sell your property, and then buy your upleg properties. Okay. Partial 1031 exchanges, a little bit of a warning. The way the math works is not straightforward. You will end up paying more tax on a partial 1031 exchange than you would think. In other words, if I did half, you would think I'm half the tax. It doesn't work that way.
Whatever's remaining, right? So if you had, let's say you sold the property for 700, you need to buy 700, you only bought 600, so that $100,000 is fully exposed in taxable amount, right? So that's why it's important when we're working with our clients on doing a 1031, we make sure, okay, we got a little bit of buffer room, so we're not identifying just 700,000. We're also being conscious of the 200% rule, so you're not having to, close on basically all of those and put yourself in a bad position. But there's a balancing act.
Yeah, that could be a whole session on 1031 exchange because the way that it works is it's almost like not fair. It's like, oh, okay, so I had somebody who was going to pull out $100,000 on a 1031, and it ended up being as if they weren't doing a 1031 on the rest of the $500,000 property because the way that the IRS runs the math. So,
well, like with all these things, it's just very intricate. You need to make sure that you have the right people in place. I mean, the ideas are great, but the implementation, you need to have the right people that are assisting you with.
You need to get an assessment done, a tax projection. One of the things I would say to all the listeners is if you are considering and thinking about selling or have sold a property or planning on selling, to get a analysis done on what is the tax, whether from your current accountant or from somebody. It could even be us, to get that assessment, because after the fact, people are like, "Oh my gosh, what happened?" They didn't expect.
You don't know. Yeah,
they didn't know that there was recaptured all that wonderful deductions that they had to pay it back.
Yeah.
So
And-
they didn't know. So going back to capital gains,
There are certain types of trusts that can defer capital gains tax. If your sale is significant enough, they certainly make sense to do that. What that allows you to do, sell your asset, use this trust, defer the tax, invest part of the money any which way you want to, pretty much, and then spread the tax out so you can offset it much more easily, like with your ongoing real estate operations. There's also charitable trusts that can act in the same fashion, where you get a tax deferral on the actual sale and only pay tax on the income. There's also charitable trusts where you can use the charitable trust to offset the tax.
And these
So-
are things that are not required. We're not talking about those that are real estate professionals. This has nothing to do with. This is just in general. You set up the trust
Correct.
appropriately, but maybe we could solidify that with a little kind of a numeric example, if we don't mind.
Sure. So let's assume for a second I have a $500,000 of capital gains. I bought the property for 50 grand. Somebody came along and offered me 550,000 for the property. Okay, great. I want to sell it. I set up one of these trusts. The trust itself is tax exempt. So there's no tax on the sale. We complete the sale. Now the money sits inside the trust, and the only thing that's taxable out of the trust is whatever income I pull out of the trust. Does that make sense?
That would be a potential. So, I mean, basically, that's another option beyond doing a 1031. You can do a 1031 if you want to
Yep.
leverage up and buy more real estate. This is just another option
Yeah.
that you could potentially explore.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.